Looking ahead to 2024, we think that the outlook for US GDP growth is likely to revert back towards its longer-term potential growth rate, led in particular by the outlook for the US consumer sector, which makes up 70% of US GDP. Other drivers of US GDP growth include business investment, net exports, and fiscal spending, all three of which we think are likely to be lower levels than we saw in 2023. The US consumer is therefore the main area of focus for the marketplace, and one where we think there's going to be increasing pressure in lower to middle income cohorts due to the cost of living increases and a drawdown of pandemic levels of savings. In addition to that, we think that the fiscal outlook for the US remains uncertain, with high levels of starting debt to GDP and growing concerns about the fiscal deficit, which will mean that the market will be uncertain about further fiscal support should it be needed for the overall economy at large. In this context, we think that this will provide a strong backdrop for high-quality US fixed income assets, including government bonds and high-quality corporate bonds, led by the potential for capital gains as yields move to lower levels, combined with a high starting level of income as we approach 2024. As we start 2024, we think that one of the most attractive sectors is the financial bond space, in particular high-quality senior bank bonds from European banks issuing in US dollars, as well as debt issued by high-quality US banks, which start with very attractive levels relative to the rest of the marketplace. In the broader corporate marketplace, we think that there are expensive valuations as we start the year, in particular in sectors such as consumer, retail, healthcare and TMT. The utility sector is a sector that also starts with a moderate degree of valuation with risk to the downside, in the sense that we are likely to see a greater degree of supply as capex needs in the utility sector accelerate into 2024. We think there are opportunities in the government bond sector itself, in particular in the US, the inflation-linked markets, which have had a difficult 2023, start 2024 with a more attractive valuation starting point, albeit not quite at levels which are attractive enough for us to invest just yet. Although the outlook for commodities in both hard commodities and agricultural commodities is uncertain, we think this will provide an opportunity at some point in 2024 in the inflation-linked markets to be overweight relative to nominal bonds. As economies outside of the US evolve at different speeds to the US, this will provide the opportunity for us to invest in non-US government bond markets, which will be additive to the strategy if we think there is enough value in those. In summary, the potential for capital gains from high-quality US fixed income assets, together with the high degree of starting yield, will provide investors with a strong potential for total returns in 2024.